Hello students, welcome back to this discussion of chapter 4. In this part of the video, as you can see, we will start a new concept called closing entries. The name closing it itself self-explanatory. We will see how. Okay. But before moving to the concept closing entries directly, just take some time and think about a particular scenario. A very simple scenario here is presented. Suppose the year-wise salaries expense of a particular company is $25,000, $30,000 and $35,000. That means first year the expense is 25,000, second year it is 30,000 and in the next year it is 35,000. Suppose this is expense of 2018, this is for 2019 and this is for 2020. Very simple. And for simplicity, also assume that this company has always paid salaries on time and no salaries accrued any year. Just for understanding the concept, we are keeping the examples very simple. So this is the, if we do the simple ledger, it may seem like this. Suppose in the year 2018, salaries expense will be debited by 25,000. In the year 2019, salary expense will be debited by 30,000. In the next year, the salary expense will be debited by 35,000. And we know that we don't have any credit here in the salary expense part, and we know how to calculate the balance. Suppose the first balance is this debit 25,000. Next the balance will increase because we are debiting more an account that has debit balance, so it will become 55,000, 25 by plus 30. Then in the next year it will be more and it will become 90,000, 55,000 plus 35,000, right? So this is the at the end of the year 2018 the salary expense balance will be 25. At the end of the year 2019 the salary expense balance will be 55, and at the end of the year 2020 the salary expense will be 90,000. Okay. So remember that we prepare our financial statement from trial balance, or to be specific, adjusted trial balance. And I hope you remember that trial balance are prepared directly from the ledger. So whatever balance we get from ledger, we put it on the trial balance, and then the trial balance move to the financial statement. So just think about that, you are preparing your financial statement for the year 2018, you are getting this balance, salary expense 25,000, you will write in the income statement salary expense 25,000. In the year 2019, you will write 55,000 because that's the balance you are getting from the ledger, and next year you will write 90,000. Is it the right thing to do? If the salary expense is 55,000 in the year 2019, is the salary expense is 90,000 in the year 2020? Exactly no. So here, if we follow this approach, we may incur into some type of serious error. Okay. So what can we do? We can do this. We know that expense will be debited, okay, that's fine. But before moving to the next year, because we know from the accrual principle that the revenue and expense shouldn't carry it forward to a new to the next year, right? So we will do that. How? Before starting the next year, at the end of the previous year, we will put a opposite entry. Suppose our salaries balance is 25,000. So before going to the next year, we will have a credit entry of 25,000. So balance 25, debit, credit entry of 25,000, it will make the balance 0. So in the next year, whatever you do, the previous year balance will not come. See here that the next year the expense was 30,000, the balance become 30,000, not the 55,000 like before, right? And the next year also, at the before starting the year 2020, at the end of year 2019, we have again closed the balance of salaries by crediting it. It had debit balance of 30,000, and we have credited 30,000, and that's why the balance became 0 at the end of the year. So we are doing something so that our balance reflect what is the total actual expense of a particular year. So what are we doing actually? We are going opposite to the actual balance. So we know that if you want to reduce any balance, we have to go to the opposite direction. Salaries expense, they have debit balance, that's why if you want to make them 0 or if you want to reduce them, we have to do credit. That's what we have done, and that's what we call closing entry. So now if you don't understand the closing entry, don't worry, the whole 2 video is for that. This is for just understanding why we are doing the closing entry, just for your basics. What is the rationale of doing it? What is the rationale? Rationale is that we don't want our expense balance of any particular year to go to the next year. That's why before going to the next year, we have to make the balance 0, so that balance do not get carried forward to the next year. Okay, right. So this is what we call a particular step in our accounting known as closing entries. It takes place after you prepare the financial statement. So this is the accounting process. So after you are done with the financial statements, then you have to put a closing entry, which is normally a journal, a special type of journal. And after closing entry, you also prepare the post closing trial balance. We'll see, no worry about that. Okay. So how the closing entry is done? First of all, we have to know which accounts need to be closed. I hope you remember that there are many types of account. Suppose there are asset account, there are liability account, there are owner's capital account, there are revenue account, there are expense account, there are owner's drawing account, right? So we got to know from our concept check, our basic discussion, that expense shouldn't get carried forward. So expense account should be closed by closing entry or anything other than that. Okay. But not only the expense account, there are other account as well. The revenue accounts, expense account and drawing account, these are known as temporary account. And these accounts, since they are temporary, we have to close them before moving to the next accounting year or next accounting period. That's why they are known as temporary accounts. We do not want our revenue account or revenue balance to get carried forward to the future year. We don't want our expense account to be carried forward to the next year. Okay, so these 3 fall into the category of temporary account, and all the other 3, rest of the 3, they fall under the category of permanent account. Why they are permanent? Just simply think about a particular example. Suppose all asset accounts are permanent accounts, so these accounts are not closed or they do not need closing. Why? Just think about a particular scenario. Suppose at the end of December 31, you had a cash balance of $50 crore, right? $50 crore at the end of year 2019, right? At the year end of 2019, you had $50,000 cash balance. At the start of 2020, what will be your cash balance? 0? No, your cash balance will be the same amount, right? So that means that asset accounts, liability accounts and owner's capital account, their balance do get carried forward and should get carried forward in the next year, unlike these 3 accounts. They are known as permanent account. So this chapter is about, or this video is about closing entry. So if we think that which account we have to close, these are the 3 accounts we have to close: revenue account, expense account, drawing account. Okay, and how we close it, I think you already got the idea. Suppose you have to close 3 types of account, right? Revenue, expenses and drawings. We will have to close it step by step. Suppose first we have to close the revenue accounts. We have to close the revenue accounts, and we have just saw that if we want to close any account, we have to go to the opposite direction of the balance. Think about the revenue accounts. What balance they have normally? The revenue accounts, they normally have credit balance. That means they have, or their credit side is always higher than the debit side, right? So now if you want to close the revenue account or make the balance of revenue account to 0, what should we do? We have to find out what was the last balance of revenue account. Suppose here in this example, we have a revenue account called service revenue, and the last balance of service revenue of that particular year or particular month, October 31, the balance was 10,060. So if we want to make the balance 0, normally the service revenue have credit balance, normally have to make the credit balance 0, we have to debit the same amount. So in the first closing entry, revenue account will be debited. We are going the opposite direction to close the account or to make the balance of the account 0. Okay. So first task in our closing entry will be, we have to debit the revenue account by the balance of that revenue account at that time. And we know that if we want to debit something, we have to do the same amount of credit, right? So here we will create a new account for this closing entry task, and then account is known as income summary account. The revenue account will be debited and income summary account will be credited by the same amount. Very simple. So first task is done. We have closed. If we prepare this journal, this first journal, our revenue account will close. Suppose here we have only one revenue account, that's why we have debited only one account. If we have multiple revenue account, we will debit all of them. Okay, this approach is same. So after closing the revenue account, now we have to close the expense account. Again, expense account, like salaries expense, they normally have a debit balance. Suppose these are the debit balance of this particular expense account. Suppose supplies account or supplies expense account have debit balance of 1500. Depreciation expense account had debit balance of 40. Insurance expense have debit balance of 50. Salaries expense has had debit balance of 5200. Okay. We have 1, 2, 3, 4, 5, 6. We have 6 different expense account, and we want to close them because all of the expense account we have to close. So the idea is very simple. Since they have debit balance, we have to credit all the accounts. So if we credit the supplies expense by 1500, the supplies expense balance will become 0. Same thing will go for other expense account. So all the expense account we have to credit them in the closing entry if you want to reduce their balance to 0 or we want to make their balance 0. So here 6 type of account we have created, and again for equal amount of credit we must have an equal amount of debit. So the total of these expenses are 7740. Okay. So 7740 will be debited in the income summary account. Okay. So first job we are done. We have closed the revenue account. Then we have closed all the expense account, and whatever the which account we have used to get this help, we have used a new account named income summary in our process. So now it is very simple, right? But now let's just think that income summary was once credited by 10,600 and now it is debited by 7740. Okay. So what does this two difference means? They are different, right? 10,600 and 7740. Exactly, you have guessed it right. This 10,600 can also be called as the profit. Sorry, extremely sorry. This 10,600 can be known as the revenue of the company, and this total 7740 can be named as the total expense of the company. Actually, it is the total expense of a particular company. Of this company we are doing the closing entry. Okay. So we are done with closing the revenue account, we are done with closing the expense account. Now it's time to close the income summary account we have created. In the previous example, we can see that we have created income summary account more than the debit, and now we have to, this is a temporary account also. So if we want to close that temporary account, we have to find out the difference. Okay, because since we have created income summary more than the debit, the income summary will also have a credit balance. So if we want to close the income summary, we have to debit it by the gap. So if we debit the income summary account now by 2860, then the debit side and credit side of income summary ledger will be same. No worry, we will show you, I will show you that in the next video. For now on, just think about that the third task will be to close the income summary. Since the income summary now have credit balance, now we have to debit that income summary account by 2860, the gap between the revenue and expenses. And this 2860 can also be called as the profit of that particular company, and we know that profit increases owner's capital. So we can use, for our credit, we can use owner's capital. So we are creating owner's capital account by 2860. In that way we are closing the income summary account too, and we are moving the profit to owner's capital account by creating it. Okay, so first task, revenue account close. Second task, close the expense account. Third task, close the income summary account we have created for closing the revenue and expense account, right? Very simple. So our main job is actually done, and we have only another account to be closed, and that is owner's drawings account. Owner's drawings account normally have a debit balance. Suppose the owner's drawing of this company at this particular accounting period is only $500. So if we want to close that owner's drawing account, we have to credit owner's drawing by 500. And since drawings will decrease the owner's equity, so we can use the owner's capital account as a debit to close the drawings account. So when we create the owner's drawing, we debit the owner's capital, and in that way we can also close the owner's drawings account. So actually what is happening here is that on the revenue and expense we are getting profit, and by this entry the profit is being transferred to the owner's capital. Profit is increasing the owner's capital, right? And in the drawings normally decreases the owner's equity. So by doing this last closing entry, we are actually transferring the owner's drawing balance to the owner's capital, and actually the drawings is not increasing, rather it is decreasing the owner's capital, because we know that owner's capital normally have a debit balance. Owner's capital normally have a credit balance. So whenever we debit the owner's capital, that means we are reducing the owner's capital, and that's very logical, because the drawings, our owner's equity and owner's capital, they get decreased, right? So whenever anybody asks you to prepare closing entry, just remember one thing: you have, by preparing closing entry or closing entry journals, you have to prepare only 4 journals. First journal to close the revenue account, second journal to close all the expense account, third journal to close the income summary account you have created for the first 2 journal, and the last one you have to close the drawings account. And that's all about closing entry journals. In the next video, I'll try to reduce some of your confusion by actually by telling you what is actually happening in the background by this closing entry, or what effect closing entry has on our accounting period or accounting process. Okay, so inshallah we'll see you soon. Thank you for your patience, and in the next video, as I have already mentioned, I will talk about the logic behind the closing entry, or what actually the effects of closing entry. Stay with me.